Greetings, everybody. Welcome to financial accounting. For those of you who are watching on YouTube, this is Spiceland's textbook of financial accounting, 5th edition, and we're dealing with chapter 7. I am doing this recording because I teach accounting, and but I also post them because I find that many people benefit from these recordings. So we're going to get started, guys, talking about long-term assets. Okay. So there are tangible and intangible long-term assets. Tangible assets are physical assets that have a physical substance, such as land improvements, buildings, equipment, natural resources. Intangible assets lack the physical substance, but my goodness, when you look at balance sheets, they are pretty powerful and can consist of a lot of money. They usually are based, or their existence is always based on a legal contract. Some intangible assets include patents, trademarks, copyrights, franchises, and goodwill. We're going to talk about all these in this session. So Darden restaurants, Red Lobster, Olive Garden, the Capitol Grill, those are the three I know of well. Longhorn Steakhouse. On their balance sheet, you see that PP&E, property, plant, and equipment, was 3.3 million or 3.3 billion, but the intangible piece was half of that. So it's a pretty significant amount of value. Excuse me, I just got a text, so it's a significant amount of value, the intangibles. Acquisitions are the purchase, the acquiring, the gathering of assets. We're going to talk about that. Regarding property, plant, and equipment, when we acquire PP&E, the way in which we record the PP&E is by taking the original cost of the asset and adding all expenditures necessary to get the asset ready for use. So, in the example of land includes the cost of the land and any expenditures that are necessary to get the land ready for its intended use. So it could be real estate commissions and fees. It could be back property taxes or other obligations that in order for you to purchase that land, you have to satisfy those deferred costs that someone else has not paid. Or it could also include clearing, filling, and leveling the land. So in this example, the computation of the cost of land would be what you purchased it for. It's like land and the existing building, the commissions, any back property taxes to get them current, title insurance, cost of removing an existing building. And then do you see here, less salvaged materials from the existing building. So say you were able to receive some money because you sold something related to getting rid of the building. You'd subtract that amount. Cost of leveling the land. So a company wouldn't just show 500,000 as the cost of the land or the basis of the land. They would show 590,000 all costs necessary to get the land ready for its intended use. Does that make sense, guys? Okay. All right. Moving on. Let's look at the problem. This problem, I just wish this wasn't in the way, and I wish I knew how to reduce this. The Italian pizza company purchased land as a factory site for $90,000. Prior to construction of the new building, the land had to be cleared of trees and brush. Construction costs incurred during the first year are listed below. The question is, determine the amounts that the company should record in the land and new building accounts. So I'm going to just give you a minute to try to work this on your own before I go and go through it. So take a minute. Okay, so if the land was purchased for $90,000, then, and this is, we're going to separate out how much will be the land be valued at and what will be put into the new building account. Okay, so the purchase price of the land clearing costs, less the sale of firewood. The architect fees are for the building, not for the land. The legal fees for title investigation would go to the land. And then the building construction costs are linked for the building. So do you understand the land that cost basis will be $98,100 and the building will be basis will be $430,000. The current property taxes are an expense that would be in the income statement. If there were back property taxes, that would be added to the basis of the land. But in this case, the current property taxes are a common expense that will be incurred every year, and that is taken into as an expense on the income statement. Any questions on this? Okay, so land improvements, what are they? Examples of improving land would be parking lots, sidewalks, driveways, landscaping, lighting systems, fences, and sprinklers. Buildings can be administrative offices, retail stores, manufacturing facilities, storage warehouses. The cost of all necessary to get the building ready for use would include real estate commissions and fees, inspection costs, remodeling costs. But those costs, like property taxes, that happen all the time, are expensed when they're incurred. Equipment can be machinery, computers, office equipment, vehicles, furniture, fixtures. The additional costs of that equipment could include sales tax, shipping, assembly, and any cost to prepare the asset for use. But no maintenance costs, those items used continually incurred, get expensed on the income statement. So in this case, if we have a piece of equipment that we purchased for $82,000, we would add the sales tax, we would add the transportation to get it to our location, any shipping insurance, and the cost to install it. Oftentimes, those pieces of equipment have to get put together. So in this example, we would include for the basis of the equipment, $91,000. Now, many times, companies just don't buy one piece of equipment. They may have a group of items that get purchased at the same time. And so it's not, the individual items aren't separated out. So when you purchase more than one asset at a time, this basket purchase will determine the values based on the allocation of the total purchase price related to each of the fair values of the individual assets. So in this case, we purchased a basket for $900,000 of land, building, and equipment. When we allocate the values of the items separately, they total $1 million. But what we'll do in order to figure out how much we assign to each, the land, the building, or the equipment, is we take that percent of these fair value. So if land is 20% of the whole value of the basket, then we'll take 20% of 900,000 to allocate to the land. You see, the entire purchase was 900,000, but the land was 20% of the whole value of the basket. So 20% of 900,000, we will show the land to be valued at 180,000. The building is allocated at 70% or 630,000 of the purchase price. And then the equipment would be at 10% of the purchase price. So here is a problem similar that we're going to go over right now. Red Rock Bakery purchases land, building, and equipment for a single purchase of $600,000. However, the estimated fair values of the land, building, and equipment are $175,000, $455,000, and $70,000 respectively, for a total estimated fair value of $700,000. Determine the amounts Red Rock should record in the separate accounts for the land, the building, and the equipment. So as you can see here, we did the same thing. We took the estimated fair values, created a percent. 175 of 700 is 25% of the value, or the allocation. The building is 65%. The equipment is 10. So we'll use those percentages and apply that to the purchase price to come up with the amounts. I'm going to give you just 2 minutes to look at this while I go grab a drink. I'll be right back. Okay, moving on. A company makes a basket purchase of land, buildings, and equipment with an estimated fair value of $70,000, $150,000, and $30,000 respectively. The purchase price is $210,000. How much should be recorded to the land account? So I want you to take a minute and answer in the chat box what you think these amounts would be. Oh, put your answer in the chat box and we'll go from there. Can you guys hear me? Okay. Okay. Looks like some of you are answering, and you guys are right. The question, the response is C. You would take the land's fair value of 70 to the whole total of the fair value, 250, comes up to 28%. Therefore, the purchase price of 210 times that 28% would give you the cost that will go to the land. Now, there are natural resources that are assets, such as oil, natural gas, timber, salt. These get distinguished from other assets because they are physically used up or depleted. So the natural resources will be recorded at cost with all the other costs necessary to get the natural resource ready for its intended use. Know that tangible assets such as land improvements, buildings, equipment, and natural resources are recorded at cost plus all costs necessary to get the asset ready for its intended use. So we're going to now take a look at intangible assets. Intangible assets can include patents, copyrights, trademarks, franchises, and goodwill. They lack a physical substance, yet are very valuable. And they generally are based on a legal contract. Now, intangible assets can be acquired by a purchase or being developed internally. But I will tell you 99% of the time, they are shown on the books as a purchase. The top brands, as you see, now this is a couple years ago. I'd love to see how it's changed. But Apple was determined a brand value, one of the largest, with Google coming in next. And then Coca-Cola behind it. I am getting a new edition for spring, so I'm going to have to look at this and see how things have changed. A patent is the exclusive right to manufacture a product or to use a process. It's granted for a period of 20 years. And when it's purchased, we capitalize the purchase price plus legal and filing fees. When it's developed internally, we only capitalize the legal and filing fees because all research and development costs are expensed. Those are for patents. For copyrights, an exclusive right of protection given to the creator of a published work. This is granted for the life of the creator plus 70 years after the creator passes. It allows the person that holds that copyright to pursue legal action against anyone who attempts to infringe on the copyright. And the accounting is just like patents. If they are purchased, you take the capitalize the purchase price plus legal and filing fees. And if they are developed internally, it's just going to be your legal and filing fees. Trademarks, which are words, slogans, or symbols that identify a company, product, or service. Trademarks can be renewed indefinitely in 10-year increments. Again, you would capitalize the legal, registration, and design fees. Advertising costs are going to be expensed as they are incurred. Franchises are basically purchased because a particular individual wants the exclusive right to use that name and sell its products within a certain area. The franchise records the initial fee as an intangible asset, but each year that they may have to pay fees to the franchise, those are expensed. Now, goodwill is a big intangible. This is recorded only when one company purchases another company. The way we determine goodwill is by taking the purchase price minus the fair value of all identifiable assets that were acquired. And the difference is goodwill. So assets acquired less liabilities assumed are what we call our net assets. And goodwill is that amount that exceeds the fair value of all identifiable assets. Now, many people will say, well, why would someone pay more for a company than just the assets sitting on the books? Because there is clear value in purchasing a company that has already been built up and established. So in this example, one company acquires another for $36 million. The following information is known for the acquired company. The fair value of the identifiable assets, $50 million. The fair value of the identifiable liabilities are $24 million, which gives the purchase price, excuse me, those are the, that's the information we're aware of. The question is, how much is the acquiring company going to record goodwill for? So if we are purchasing it for $36 million, but our net assets are $26 million because of the 50 minus our liabilities of 24. So if our net assets are 26 million, then our goodwill is going to be the difference of what we purchased the company for minus our net assets. Again, net assets are assets less the liabilities we are assuming. Remember, intangible assets include patents, copyrights, trademarks, franchises, and goodwill. Okay, so here we've got Satellite Systems modified its Model Z2 satellite to incorporate a new communication device. The company made the following expenditures. So you see here, we've got basic research to develop the technology, engineering design work, the development of a prototype, testing and modification of the prototype, legal fees for the patent application, and legal fees for the successful defense of the new patent. During your year-end review of the accounts related to intangibles, you discover that the company has capitalized all the above as costs of the patent. Management contends that the device represents an improvement of the existing communication system of the satellite and therefore should be capitalized. Which of these above costs should Satellite Systems capitalize to the patent account in the balance sheet? Which of the above costs should Satellite Systems report as research and development expense in the income statement? And what is the basic criteria for determining whether to capitalize or expense intangible related costs? I'm going to give you a minute to try to attempt this on your own. Just about 3 minutes, 2 minutes. Hey guys, so the patent costs to be capitalized will only be the legal fees for a patent application and the legal fees for successful defense. I will tell you, if there are legal fees for an unsuccessful defense, those would be expense because it means they didn't win in regards to the patent. So in this example, all legal fees will be capitalized and everything else will be expensed on the income statement. The basic research, the engineering design work, the development of a prototype, and the testing and the modification. And then the next question here says, what is the basic criteria for determining whether to capitalize or expense intangible related costs? When you purchase intangible assets, they get capitalized. But internally developed intangible assets are expense except for most legal fees. So guys, what do you think? Which of the following is an exclusive right to manufacture a product or to use a process? Think of the COVID vaccinations lately. Patent. It's the exclusive right to manufacture a product or use a process. 20 years. So, what happens after the acquisition of an asset? There can be repairs and maintenance, additions, improvements, and litigation costs after an asset has been acquired. We will do one of two things. We will either expense or capitalize those items. So how do we know what we're going to do? We expense them if they benefit just the current period. But we will capitalize them if they benefit not just the current period, but also future periods. So when you look at this slide, repairs and maintenance, such as making major repairs that are going to possibly allow the asset to have more useful life, then we capitalize it. Additions, adding new components that are going to enhance the asset, get capitalized. Improvements, replacing major components like an engine would be capitalized. But repairs and maintenance, just a certain level of benefits like oil changes, rotating various contraptions. You can tell I'm not much of a mechanic, but you know, basic care on the equipment is expense. Now, if you look at the bottom, incurring litigation costs to defend the legal right to the asset will be capitalized, but if the defense is unsuccessful, we're going to expense it. We record as an asset or capitalize costs that benefit future periods, but we expense items that benefit only the current period. So guys, which of the following costs would be expense? A, adding a refrigeration unit to a delivery truck. B, adding a new suspension system to a delivery truck that will allow for heavier loads. C, adding a new transmission to a delivery truck, which will increase its life and future benefits. Or D, performing a tune-up on the delivery truck. What do you guys think? The tune-up would be expense. All of the other items would enhance the life of the asset, and such would be capitalized. Now we're going to talk about depreciation or allocation of the property, plant, and equipment. Now, for our purposes, depreciation is allocating an asset's cost to be expensed over time. So we purchase an asset today, but we have future benefits. So that asset has a useful life of so many time periods. So we want to allocate the cost of this asset we purchased today for the benefit, the time periods it is going to benefit, which is why what we call depreciation. It's the allocation of a portion of the asset's cost to an expense over all the periods that are benefited. So if a local Starbucks pays $1,200 for equipment, an espresso machine, with a useful life of 4 years, that espresso machine is supposed to last 4 years. So what we would do is take that $1,200, divide it by 4 years, and show a depreciation expense of $300 for each of the 4 years. We debit our depreciation expense and we credit an account, a contra account called accumulated depreciation that will offset the asset. So this will be our journal entry. On our balance sheet, you will see the book value after year 1 of this asset to be $900. The cost of the equipment less the accumulated depreciation that has been taken on the asset. Students sometimes mistake accounting depreciation as recording the decrease in the value of an asset. Depreciation in accounting isn't a valuation process. It's an allocation of an asset's cost to be expensed over time. A huge important note: land cannot be depreciated because its service life never ends. We only have so much land, and land cannot be depreciated. Now, the natural resources can be depleted, which we'll talk about later, but the actual land is never depreciated. There are various methods to depreciation. The 3 common: straight line, declining balance, and activity-based. Depreciation, again, is the allocation of the asset's original cost to an expense during the period's benefited. It doesn't refer to the change in value or selling price. It's just allocating the asset's original cost to be expensed over its useful life. So when we're dealing with straight line depreciation, the information we need is the cost of the truck, what we estimate the residual value, or sometimes you hear it's called salvage value. Once it's used up, what is that value going to be? One second here. And then what is the estimated service life of the asset? So we have the cost of the truck less the salvage value, which would end up being $35,000. And the estimated useful life for straight line depreciation is 5 years. So in this case, we would take $7,000 per year as depreciation on that truck. So in this case, okay. So in this case, you start with the book value of 40. We know it's going to end at 5,000. We need 5,000 remaining once we've depreciated. But we're going to take the 35,000, the cost minus the salvage value or residual value, over 5 years. So we take 20% each year. So at the end of the 5th year, the book value of the asset is 5,000. This is straight line depreciation. Remember, if a truck is purchased in mid-year, then you only take the allocated portion based on when it was placed into service. So in this example, when a truck was purchased on March 1st, it's 10 months out of 12 months. And so we would put 10/12 of that assets depreciation in year 1. And then in year 6, we would take the remaining 2 months out of 12 months. Okay. It's still the same amount of depreciation. It's just allocated a little differently. So guys, how much depreciation should be recorded in the first year for a delivery truck purchased on April 1st with a cost of $30,000, an expected life of 5 years, and an estimated residual value of $5,000, assuming the straight line method? Take a minute and tell me what you think. So again, in this example, cost of 30, residual value of 5 means the depreciable cost is 25. And over 5 years. So we would only take 9/12 in the first year because we purchased it April 1st, meaning January, February, March, it was not purchased. So 9/12 of the $5,000, or I guess that would be 75% of 5,000 would be the $3,750. Sometimes we have changes in depreciation estimates. Assume that after 3 years, Little Keek Sandwiches estimates the remaining service life of the delivery truck to be 4 more years for a total service life of 7 years, rather than the original 5. Little King also changes the estimated residual value to $3,000 from the original estimate of $5,000. How much depreciation do we take in years 4 through 7? One thing important to know is we never go back and fix anything. We just go forward with the changes. So in this case, the book value at the end of year 3 would be $19,000. Now we have the new residual value. Instead of 5 is 3, which gives us a new depreciable cost of 16. And we have 4 additional years. So we're going to take 4,000 each year. Okay. Now, this method can confuse so many people, but if you work with me and just hear what I'm trying to say, it makes it so much easier. Don't try to make double declining work like the straight line method. It's different. Hear me out. Double declining is basically doubling the depreciation rate of what was used in straight line. It's basically taking depreciation a lot faster earlier. Okay, that is the only way we think of the comparison between straight line and double, is just whatever straight line is, we double it, and then forget about the straight line method when we're dealing with double declining. Okay, so the book value we start with, and we know we're going to have a salvage value, and we can never go below that residual value. all we do with double declining is take that rate, in this case 40%. We take 40% of the book value. We don't take that. Remember how in straight line we took the depreciable cost? Don't do that. We take the book value times that double rate, 40%, and we come up with a depreciation amount, which is double. Then we adjust the book value at the end of the year by subtracting our accumulated depreciation from the book value. So at the end of year one, we have a new figure, 24,000. We will now take times 40%. We don't continue to use 40,000. We have a new value, 24,000. We'll take it 40% to come up with our new depreciation amount. And then again, in year two, we have a new book value. We'll take 14,400 times 40% for year three, or 5750. And we, again, each year we adjust to come up with a new book value. Here's the catch. Oops. We cannot go below 5,000. So in the fifth year here, we only take as much as necessary to go to 5,000. Okay? This $184 is the depreciation we take in year five to just get us to the residual value of $5,000. It really isn't a hard method if you try not to do it the same way as straight line. Remember, the book value begins at the full book value. You double the rate, but after each year you adjust the book value. And the new depreciation amount is going to be based on this new book value times that double rate. So remember, guys, when using the declining method, mistakes are commonly made in the first and last year. In the first year, students sometimes calculate depreciation incorrectly as cost minus residual value times the depreciation rate. Don't do that. The correct way is in the first year is to simply multiply the cost times the depreciation rate. In the final year, some students incorrectly calculate depreciation expense in the same manner as in earlier years, multiplying the book value by the depreciation rate. But remember, in the final year, the depreciation expense is only going to be the amount necessary to reduce the book value down to the residual value. So guys, how much depreciation should be recorded for the first year of a delivery truck with a cost of $30,000, an expected life of 6 years, and an estimated residual value of $6,000, assuming the double declining balance method? Take a minute. Okay. Remember, when we look at this, we are not going to do an depreciation 30 minus 6 like we would do with straight line. We would take 30,000 and we multiply it by a third. 1/6 is under straight line how much we would take each year, but double declining means we take 2/6, which is a third. So in this case, we would take our 30,000 times 33.33%, and our depreciation would be 10,000 for the first year. We'll go through some problems like this so you'll have it figured out. Guys, activity-based depreciation is just like straight line, except in using years, we use some driver, miles, hours, some driver that pushes the depreciation. In this case, we have a delivery truck, and we expect the delivery truck to have an estimated service life of 100,000 miles. So we take the 40,000 minus the residual value of 5, so 35,000, divide that by 100,000 miles, which we get 35 cents a mile. So if in the first year we went 10,000 miles, we would depreciate it 3,500, 35 cents a mile. So you see, each year the number of miles driven would be multiplied by the depreciation rate per mile. Instead of using years, we're using miles, but it's just like straight line. Now, guys, ultimately between the three methods, the end result will always be the same, but it's the timing that's going to make a difference. Double declining, you can see, goes a lot faster in beginning years. Straight line is flat. It is the same amount consistently every year. And the activity based is based on the activity of a machine or equipment. Over time, the amount's going to be the same. But as you see, it varies each year. Double declining is going to happen a lot faster. Straight line is as straight as can be. And activity-based is going to be based on the miles or the hours used, that you've used the machine. Know that 92% of companies use the straight line method. 4% use double declining, and 3% use activity-based. So you're asking, why do we need to know all these if everyone uses straight line? And my answer is, this is an accounting class. At least you can learn the various methods. Know that tax depreciation is different from book depreciation. Tax depreciation uses an accelerated method. Right now we have makers, but modified cost recovery system, which helps reduce taxable income more in earlier years. But for financial reporting, most companies use the straight line method. All these three are acceptable methods for financial reporting, but most companies do use the straight line method. So let's look at this example. The donut shop acquired equipment for $19,000. The company uses straight line depreciation and estimates the residual value of $3,000 and a 4-year service life. At the end of the second year, the company estimates that the equipment will be used for additional 4 years for a total service life of 6 years rather than the original 4. And at the same time, the company also changed the estimated residual value to $1,200 from the original estimate of $3,000. Calculate how much the donut shop should record each year for depreciation in years 3 to 6. So as you see here, the cost of the equipment is 19, less the accumulated depreciation that we've taken already in years 1 and 2 was $4,000 a year. So we've taken $8,000. So we have an $11,000 book value at the end of year 2. We take our new residual value of $1,200 to show a depreciable cost of $9,800. Divide that by 4 years to come up with the depreciation that we will take in years 3, 4, 5, and 6 is $2,450 each year. We don't change what we've done, but we move forward and change going forward. Any questions on this? Now, amortizing intangible assets in ways is similar to depreciation, but we don't call it depreciation. We call it amortization when we're dealing with intangible assets. So in early January, Little King Sandwiches acquires a franchise from University Hero for $800,000. The franchise agreement is for a period of 20 years. So we will show amortization the first year of $800,000 divided by 20 years, or $40,000 is our debit to amortization expense. And unlike depreciation, where we have an accumulated depreciation account, contra account, we don't do that here with franchises or intangibles. We directly credit the asset, the intangible asset, franchises, for $40,000. In addition, Little King purchases a patent for a meat slicing process for $72,000. The original legal life of the patent was 20 years, and there are 12 years remaining. However, due to expected technological obsolescence, the company estimates that the useful life of the patent is only 8 more years. Little King uses straight line amortization for all intangible assets. Record amortization for the first year. So in this case, we would just take our $72,000 divided by 8 years and show a debit to amortization expense for $9,000 and a credit to patents for $9,000. Know that we will amortize patents, copyrights, trademarks with a finite life, and franchises. But goodwill and trademarks with an indefinite life will not be amortized. So we know amortization, similar to depreciation, allocates the cost of the intangible assets over their estimated service lives. But intangible assets with an indefinite useful life will not be amortized. So guys, which of the following intangible assets will not be subject to amortization? B, trademarks with an indefinite life and goodwill. Okay. This is a full chapter. It's not a hard chapter. It's a full chapter. There's a lot to cover here. Now, what happens when we dispose or retire or sell or exchange an asset? We need to account for disposing long-term assets. Generally, the three ways we do it: we sell it, we retire it, or we exchange it. So we're going to look at those. The original cost of the truck is $40,000. The estimated residual life is 5. The estimated service life is 5. We're going to assume straight line depreciation. How are we going to handle it if we sold the truck after 3 years and we sold it for $22,000? So what we're going to have to figure out is, what was its adjusted basis after year 3? You got to figure that out in order to determine a gain or a loss. So we sold it for $22,000, but the book value at the end of year 3 is going to be $19,000. We take the original cost of the truck and we subtract the accumulated depreciation. 3 years at $7,000 is $21,000 accumulated depreciation, meaning our adjusted book value at the end of year 3 is $19,000, which means we have a $3,000 gain. It's important to know we need to wipe out the entire equipment piece here to get it off our books, to zero out the accumulated depreciation account, and then show the gain or the loss. In this case, we debit our cash, we debit our accumulated depreciation because it normally has a credit balance. We credit our equipment, and we want to take the full value and zero that out. And we show a gain on our books of $3,000. Okay. Now, don't combine the delivery truck, $40,000, and the accumulated depreciation of $21 and credit $19,000 difference to the equipment account. You have to totally zero out the delivery truck and totally zero out the accumulated depreciation from the accounting records. If you don't do it, they're going to incorrectly have a remaining balance even after the asset was sold. So we need to zero it out. What happens if we sell the truck after 3 years for $17,000? So our cash would be $17,000. Our accumulated depreciation would stay the same as the other problem of 21, our equipment of 40. And in this case, we're going to have a loss of $2,000. So we're going to do the same setup as we did in the previous example, except our cash is 17 and we will have a debit to loss of 2,000. What happens if we don't sell it? We just retire the truck. Well, there's no cash here. So we would have a loss of 19,000. If an asset is sold at the end of its first year of use, which depreciation method would result in the highest amount of gain or lowest amount of loss, assuming the asset is used fairly evenly over its life? you have to think of what will lower the book value the greatest after year one. It'd be double declining, wouldn't it? Since double declining takes greater depreciation in its first years, the book value gets lower real quick, which means then when we sell it, there would be a greater gain. Now, if we look at exchanges, an exchange is just generally a different asset with either cash given or received. So in this case, the new equipment is put on the books. We have to get rid of the old equipment and the accumulated depreciation. We show, if we receive cash, we would show that as a debit. If we had to pay cash, we'd show that as a credit. And then from that would be a gain or a loss. So the trade-in allowance is the new truck is at $45,000, but we paid cash of $22,000. Okay. And then we zero out the old truck. We get it off our books to show a gain of $4,000. If we dispose of an asset for more than book value, we record a gain. If we dispose of an asset for less than book value, we record a loss. Abbott Landscaping purchased a tractor at a cost of $42,000 and sold it 3 years later for $21,600. Abbott recorded depreciation using the straight line method, a 5-year service life and a $3,000 residual value. Tractors are included in the equipment account to record the sale. So the first thing we need to do is figure out how much depreciation we've taken on it. So if we purchased the tractor for $42,000, with the residual value of 3 means the base depreciable cost is 39 divided by 5 years. That means we would take $7,800 a year for depreciation. We sold it after 3 years, meaning we have depreciated $23,400 on this equipment. So we need to debit the cash we received of $21,600. We need to zero out the equipment account and the accumulated depreciation account. And from there, we'll come up with a gain or a loss. Okay. Now, what if it was sold for $13,600 instead of $21,600? You see, the asset and the accumulated depreciation did not change. We have to get that off our books. But the cash was different. And the loss, of course, it becomes a loss now instead of a gain. Okay. I'm going to let you guys look at the ratios here of return on assets, profit margin, and asset turnover. But the one piece I do want to address with you is what's called impairment. This is related to goodwill. We talked about that goodwill is never allocated, amortized. But there are times we will need to write down goodwill. if it's being impaired. So what we need to look at with goodwill, the first step to see if possibly an asset is impaired, is not really valued correctly, are the future cash flows less than book value? If the future cash flows are less than book value, then we know the asset is impaired. If the future cash flows are not less than book value, then we don't do anything. We go on. But step one, if the future cash flows are less than book value and the asset is impaired, we then go to step two. And we would record a loss. The loss equals the book value of an asset in excess of the fair value of the asset. So the loss we would record is the book value of the asset that's in excess of the fair value of the asset. We do not record an impairment, though, if step one is no. We only move to step two if the future cash flows are less than the book value. So if we are estimated that future cash flows generated for a long-term asset fall below its book value, then, for example, Trademark has estimated future cash flows of $20,000 and a book value of $50,000. Oops, it means it's being impaired. So then we go to step two. Yes, it is impaired because the future cash flows are less than the book value. Then we go to step two and say, okay, then how much is the fair value of the asset below the book value? The amount of loss is the difference between the book value and the fair value, $38,000. So we will have to reduce the asset. In this case, we're not dealing with goodwill. Normally it's goodwill we're dealing with, but in this case, we show the loss and we bring the intangible down to the fair value amount. Again, when you go back to accounting, conservatism is the key here. We never want to overstate assets. An impairment loss is recorded when fair value exceeds book value? No. When book value exceeds fair value? No. That's what we'll use as our loss. When estimated future cash flows exceeds book value? No. When the book value exceeds the estimated future cash flows. We record it when that happens. That's not what we will show as the loss, but that is the determining factor to know we have a loss. Record as an impairment loss only when book value exceeds estimated future cash flows. So guys, that is the gist of this chapter. There's a lot in here, but none of it's difficult. The biggest challenge is just to keep the various items separate so you don't confuse the various depreciations with one another, and make sure you understand about impairment. Oftentimes this happens with goodwill, but be aware of that. I hope this has been helpful. Have a great week.